stop. If you are planning to apply for an IPO this week, you might be making a costly mistake, because one wrong IPO can wipe out months of your savings, while the right one can literally double your money. So how do you tell the difference? In this video, I will show you exactly how to identify a good IPO, even if you are a complete beginner, and the simple checklist I personally use before investing even 1 rupee. Let's start. Most beginners think IPO means easy money. Apply, listing gain, profit. IPO stands for Initial Public Offering. It is when a private company becomes public and allows people like you and me to buy its shares. Sounds exciting, right? But here is the catch. Companies usually launch IPOs for 3 reasons. First, to raise money for growth. Second, to pay off debt, or if promoters want to exit. And this is where most beginners make a mistake. They never ask one simple question. Why is this company really coming to the market? Now let me break a myth. IPO does not mean guaranteed profit. Some IPOs are overpriced. Some are driven by hype. Some are just exit plans for early investors. If you invest blindly, you are not investing. You are gambling. Now comes the most important part of this video. If you remember nothing else, remember these 5 steps. Step 1. Business understanding. Ask yourself, do I actually understand this business? If you cannot explain it simply, skip it. Simple rule. If you do not understand it, do not invest. Step 2. Financial health. Check 3 things: revenue growth, profitability, and debt levels. You want consistent growth, real profits, and manageable debt. Red flags are continuous losses and high debt. Simple shortcut. Search the company name and DRHP summary. Look at revenue and profit trend. Step 3. Why is the IPO coming? Go to the section called Objects of the Issue. Ask yourself, is the money for growth or for exit? Growth is a good sign. Heavy promoter selling is a warning. If promoters are exiting, why should you enter? Step 4. Valuation. Even a great company can be a bad IPO if it is overpriced. Compare its valuation with similar companies already listed. Simple rule. Do not overpay for hype. Step 5. Subscription data. Look at who is investing. Retail investors, high net worth individuals, and institutions. The most important category is institutions. If institutions are investing heavily, it is usually a positive signal. But remember, hype does not guarantee success. Now you might be thinking, does this actually work in real life? Let's look at real IPOs in India. Some winners and some losers. First, a winner. Tata Technologies. This IPO had strong brand trust, a profitable business, and a clear growth story in engineering and electric vehicles. It was also reasonably priced. Result: strong listing gains and positive momentum. Lesson: strong business plus fair pricing works. Next, IREDA, a government-backed company in the renewable energy sector. It had strong demand, solid growth, and benefited from a powerful sector trend. Result: huge gains after listing. Lesson: sector trend plus demand can create powerful IPOs. Now let's look at the other side. Paytm, massive hype, big brand. Everyone was talking about it. But it was loss-making, extremely expensive, and had no clear path to profitability. Result: one of the worst listings and heavy losses for investors. Lesson: hype can destroy your money. Another example. LIC, a trusted name in almost every Indian household, but the IPO was overpriced and had limited growth expectations. Result: weak listing and long period of underperformance. Lesson: a strong brand does not always mean a good investment. Even companies like Zomato and Nykaa show that timing and valuation matter. So here is what we learned. A good IPO has a strong business, reasonable valuation, and real growth. A bad IPO has hype, overpricing, and weak fundamentals. Here is a bonus strategy most people ignore. You do not have to invest in IPOs immediately. Sometimes the best move is to wait. Let the stock list. Let the price settle. Then decide. Smart investors do not chase excitement. They wait for opportunity. Now let's quickly go through common mistakes. Applying just because others are applying. Ignoring fundamentals. Chasing listing gains blindly. Putting all your money in one IPO. Golden rule. IPO should be part of your portfolio, not your entire strategy. So next time you see an IPO trending, do not apply blindly. Use this checklist. Understand the business. Check financials. Know why the IPO is coming. Look at valuation. Analyze demand. Do this, and you will already be ahead of most beginners. If you found this useful, like the video, and subscribe to the Money Lens for simple, practical content that actually helps you grow your money. And tell me in the comments, which IPO are you watching next?